Today we're going to talk about estimated taxes, specifically what they are, if you need to be paying them, how to estimate them, and I'll actually go in and show you exactly how to make a payment. Hey everybody, I'm Mark too, and I'm a CPA, and I help online resellers grow their businesses profitably. And like some of you, I learned the hard way about estimated taxes. So quick story, in college I sold pest control one summer in California, and that summer I did pretty well, I thought, for a college student, so I made about $10,000. And this is before I was a CPA or before I had even studied accounting or taxes. And when it came time to do my taxes, I ended up owing about $1,500 just in self-employment tax. And I had penalties on top of that. And that's all because I hadn't paid my estimated taxes, which I knew nothing about. So what are they? If you're self-employed, the IRS generally wants you to send in taxes throughout the year. When you're employed at a W-2 job, we don't have to worry about it because our employer is doing that for us. But when we're self-employed, we're the boss and we need to send in those payments throughout the year. But not all self-employed people are required to make these payments. A lot of it depends on how much tax you're going to owe at the end of the year. And to determine if you're required to make estimated payments or not, there are three fairly simple rules that you need to keep in mind. The first rule is that if you're not going to owe over $1,000 of federal income tax at the end of the year, then you don't need to worry about making estimated payments. You can make the payments if you want to, but if you don't, you're not going to be charged any late penalties. So that's the simplest rule of thumb to go by. Another rule to follow to make sure you're okay is to rely on the prior year. So if you've already paid estimated taxes or had other tax withheld that equal at least 100% of the prior year tax liability, then you don't need to worry about making any additional estimated tax payments in the current year. Again, you can break it up if you want to and make payments throughout the year, but you're not required to. So if you don't, you won't be charged any late penalties. So let's say last year your tax liability was $5,000, and this year, maybe through a W-2 job, you've already had $4,000 withheld, and maybe you already made an estimated payment of $1,000. So in total, you've already paid in $5,000. So you're not required to make any further payments because you've already paid 100% of your prior year tax liability. So it's because of that rule that people sometimes say in your first year of business, you don't need to worry about making estimated payments. And that's not always true, but it often is, because a lot of times people in the prior year will have had a W-2 job where maybe they had withheld some taxes, and then in the current year they keep that job and maybe they've had the same amount of tax withheld, and in that same year they start their reselling business. But since they've already paid in an amount equal to their prior year tax liability, you're not on the hook for any additional estimated taxes. And the third rule is that you can rely on the current year. If you've already paid estimated taxes or had taxes withheld elsewhere equal to 90% of your current year's tax liability, then you don't have to worry about estimated tax payments. Now this one's a little more difficult because maybe you don't know what your current year tax liability is going to be. So how can you estimate 90% of something that you don't know what that something is? But for some people, that's the easier rule to follow. So if you know your tax liability is going to be $10,000, if you pay 90% of that, or $9,000 in the current year, then you don't have to make any additional payments until the end of the year. Okay, so before we can go pay our estimated taxes, we have to actually estimate what our taxes are going to be. So I use my own tax software to calculate mine. It's really specific, but you don't have to be that accurate. That's why they're called estimated taxes. So what I like to do is just go to a simple calculator. You can go to this website called dinkytown.net, and they provide a lot of different calculators that other websites use. And go to calculators, go down to tax, and you want to click on this 1040 calculator. So it's pretty simple. You're just going to want to open up each of these sections, and you're going to want to fill out your filing status. Let's say you're single. That's going to determine your standard deduction. Let's say you have one child under 17. If they're 17 or older, they do not qualify for the child tax credit. Open up this income section. Let's say you have a W-2 job where you earned $50,000 for the year. So that's where you enter that. No spouse in this case. Interest is usually minimal. You can enter something if you kind of know what you get from year to year. Dividends, refunds, alimony. The most significant one will probably be this: business income or loss, Schedule C or E. So Schedule C is what most of you will have, And that's basically your profit that you've earned from reselling. It's not your sales, it's your sales after all expenses and deductions, including things like the mileage deduction and the home office deduction. So you're going to have that number from your records or estimate it somehow. So let's say this person is estimating a business profit of $20,000. Now, if you have an S Corp, that S Corp income will go right here. So keep scrolling down. Let's open up this next section, adjusted gross income. The most common deduction that you're going to have in this section that people usually have is an IRA deduction. So let's say they contributed about half of the max. So let's put $3,000. That's a deduction. So let's say they take the standard deduction. That's what most people take now. If you itemize, you can put those in here. And then on this section, it calculates your total taxable income. And on this next one, it's actually calculating your tax for you. And that's just depending on what tax bracket that you're in. So of your $53,000, about $7,500 is income tax. For the child, you get a $2,000 tax credit, so they're going to take that out of the tax. But then you also have self-employment tax, which is about 15% of your business profit. Remember that? We put $20,000 times 15%, about $3,000. It's less because there's some other things that go into it. But that's your self-employment tax. Then open up this bottom section. Let's say you had $3,000 of federal income taxes withheld for the year. You can get that from your W-2 and estimate it. And then down here, it should have already calculated, but you can hit the calculate button just to be sure. And then scroll back down to the bottom. So your total income tax was $83.14. You already paid $3,000 of that, so your outstanding bill is $53.14. So this is the number that you want. So this $83.14 is your self-employment tax of $2,826 plus your income tax of $7,489 minus the child tax credit. So that's this $83.14. And you already paid $3,000, so that is why it's showing you a tax bill owed of $53.14. So let's say you're at the very beginning of the year and this is your estimate. So that $53.14 is basically what you would break up into 4 payments and pay quarterly. So about $13.30. So then once you have that estimate, you're going to want to come to IRS.gov/payments, and you can pay with a card, through a third-party service. I like to do this direct pay. I think it's simpler. Just go to make a payment, select reason, and you will select estimated tax for your 1040. And I'm paying it for the year 2020. So it's going to take information from my most recent tax return to confirm my identity. So let's see if I pass. Put in my SOCH. So here you put in the amount, payment date, bank info, so that was a real example. I actually went through and made a payment for myself. For some reason it stopped recording early, but all you missed was the review screen and the confirmation screen. So on screen 4, it shows you all the information that you've put in so you can review it and make sure that you don't have to make any changes. And then once you submit, it takes you to a confirmation screen. And I highly recommend that you print out that confirmation or make sure that it's emailed to you, because you want to make sure that you account for that when you do your tax return for that year. And remember, with taxes, there's an exception for almost everything, so make sure you review your situation with a professional. If you found this helpful or have any questions, let me know in the comments, and make sure you subscribe. For tips and behind the scenes, make sure you follow me on Instagram at NotYourDadCPA, and make sure you click on the links below for more resources on how to optimize your tax and accounting side of your business.